All right, today on The Explainer, we are digging into what is, no joke, one of the biggest transformations we've seen in modern finance. We're talking about Morgan Stanley and how they completely reinvented themselves.
Okay, so let's kick things off with a single number, 21.6%. Now, that's their return on tangible common equity. And look, to put that into perspective for you, a number like that, it would have been totally unthinkable for this firm just 10 years ago. It's a huge sign that something deep, something fundamental has changed. And you want to know why? Because this is not your father's Morgan Stanley. Seriously, what they've pulled off is one of the most successful pivots on Wall Street, maybe ever. They've gone from being this volatile trading house, riding the crazy waves of the market, to this incredibly stable, predictable wealth management giant. And their engine isn't market swings anymore. It's steady, reliable, fee-based income. So the big question is, what's their secret sauce now? How in the world did they pull off this incredible pivot and build this new kind of financial powerhouse? Well, it all starts with a huge, and I mean massive, strategic shift. They made a conscious decision. Wealth management wasn't just going to be a part of the business anymore. No, it was going to be the very core of it. The goal was to build a financial fortress, one that could weather pretty much any economic storm you could throw at it. And when I say fortress, I'm not kidding. The sheer scale is just staggering. We're talking about the firm overseeing more than $9 trillion in client assets. Think about that. More than half of their entire revenue now comes from wealth and asset management. That's the engine now. Okay, now this is where it gets really, really clever. They built what they call a virtuous cycle. It's this brilliant ecosystem that just feeds itself. So follow me on this. Their investment bank takes a company public. Boom. Then their wealth management side swoops in and captures all that new money from the IPO. And it doesn't stop there. The employees at that new company, they're managing their stock options through Morgan Stanley at work. And guess what happens down the road when they roll over their 401ks? Yep, that money lands right back at Morgan Stanley. It's a totally closed loop, and it is incredibly hard for anyone else to copy. But they're not stopping there. It's not just about scale and this super clever ecosystem. No, they're turbocharging the whole model with something else. A huge, and I mean very real, leg up in artificial intelligence. And this just says it all, right? While their rivals are still putting out press releases about partnerships and pilot programs, Morgan Stanley has already hit a mind-blowing 98% AI adoption rate among its 15,000 advisors. They are way past the talking phase. They're doing it every single day. And look, this is not a gimmick. This is real stuff. Through their partnership with OpenAI, they've rolled out tools that are actual game changers for their people. Their AI assistant can tap into 80% of the firm's entire knowledge base instantly. Debrief automatically writes up summaries of client meetings. And Ask Research GPT, it basically puts their entire army of researchers right at an advisor's fingertips. We're talking about a real, measurable boost in productivity here. Okay, so this fortress they've built sounds pretty impressive, right? But building something that big, that fast, well, it doesn't come without risks. And now some cracks are starting to appear in the walls. You see, the firm's been getting hit with a string of regulatory fines lately. And we're not talking about just a few one-off mistakes. This looks more like a pattern, pointing to some potential systemic issues with compliance and oversight. Everything from data security to making sure advisors are doing the right thing. And for business that is literally built on client trust, that's a huge deal. And another thing, even with this amazing transformation, some parts of the old Morgan Stanley are still lagging behind. Their equities business? Absolute powerhouse. But their trading desk for things like fixed income, currencies, and commodities, what everyone on the street just calls FICC, is still playing catch-up to rivals like Goldman Sachs. And that means they can't always cash in on certain types of market moves. So how are they dealing with these risks? How are they trying to secure their future? Well, the firm's new CEO, Ted Pick, is going on the offensive. He's making some really aggressive bets on what he sees as the next big frontiers in finance. And you can see the strategy laid out pretty clearly here. First, they're diving headfirst into the private markets. That's a $5 trillion space. Then they're moving into crypto, launching the first Bitcoin ETF from a major bank to grab a piece of that action. And the big one, they're positioning their entire network to capture the lion's share of the great wealth transfer. That's an $84 trillion opportunity over the next couple of decades. Now, that move into private markets, buying a platform like Equities, that's a really big deal. What they're essentially doing is opening up one of the most exclusive clubs in finance. investing in companies before they go public. Their wealthy clients have been desperate for access to this stuff, and Morgan Stanley is basically building them a bridge to get there.
But even with all these smart, forward-looking plans, Morgan Stanley doesn't exist in a bubble, right? There are some powerful headwinds blowing out there that could definitely knock them off course.
Take the M&A game, for instance. It's an incredibly lucrative business, but their arch rival, Goldman Sachs, is still the undisputed king. As you can see, Goldman's market share is just huge, and that puts a really tough ceiling on how much Morgan Stanley's investment bank can grow in one of the most profitable areas on Wall Street. And it's not just the competition. You've got this potent cocktail of other threats, too. Geopolitical flare-ups can freeze the M&A market overnight. There's the risk that these record-breaking trading revenues we've seen lately will just go back to normal. And then, looming over everything, are new banking regulations that might force them to hold on to more cash, which means less to give back to their shareholders. So when you put it all together, what's the big takeaway here? It's that Morgan Stanley's pivot from a trading house to a wealth management machine has been, well, a masterstroke. It's probably the most successful strategic shift on Wall Street in a generation. The numbers just don't lie. From the assets they manage to their bottom line, this has worked out better than maybe even they could have dreamed. But that leaves us with one final and really important question. Have they built the most recession-proof business on all of Wall Street? It sure looks like it. But with all these new risks popping up, competition, regulation, geopolitics, you have to wonder, is the biggest test for this new fortress still yet to come?